Hello and welcome to the Fidelity Upside. I'm Emily Ananuevo. Imagine quadrupling your savings over time. Well, according to research, this is the value that advisors can add to our lives by planning for the future, saving with discipline, and by allocating to non-cash assets. In fact, in today's low interest rate and uncertain times, getting exposure to assets that offer stable returns is more important than ever. Dividend-paying stocks have historically been a smart way to protect and grow our purchasing power and work towards building our goals. So, how have dividends held up in 2020? What is their outlook for 2021? And where are there opportunities for strong returns? To help pull these pieces together, we're joined by portfolio manager and director of research, Don Newman. Don manages the Fidelity Dividend Plus Fund and others, and oversees a team of research analysts who spend their time examining companies' future potential. Don, welcome to the show. So great to have you here.
Hi, Emily. Great to be here.
Looking forward to our conversation. Now, if you'd like to ask Don a question during the show, feel free to do so by just clicking on the Q&A icon you see on your screen, submitting your question, and we'll get to as many as we can during the show. Don, many investors on the line today are invested in your fund. So let's begin by sharing a bit about you and what led you to a career as a portfolio manager.
Sure. It's actually sort of an interesting little story. I'll take you back. I'll try to be brief here. But when I was about 12 years old, I had sort of started to get an interest in financial markets, and I decided I'd like to, maybe try buying a stock. And it went on to one of our family vacations, and we sort of had flew down to where we were going, and my mother had remarked on how wonderful the service of the airline had been. So in my infinite wisdom, I decided that it would be great to buy a few shares with some money made sort of mowing lawns in this particular airline. I did so, and fairly basically sheer luck. A couple months later, the airline got taken out for like 100% premium, and I ended up making a small amount of money. But to me at that time, it was really good. As I say, it was totally lucky. As I found out and I sort of look back at it, basically the airline had to sell itself because it was running out of money. It was probably a terrible, in investment terms now, it would have been a terrible decision, but it really sort of piqued my interest. And fast forward 10 years later, I got the opportunity to move down to New York and work for sort of an investment bank in the investment research department on Wall Street. Spent a few years there. And then one of the biggest and sort of most respected clients we had was Fidelity. And a couple years into my role at the investment bank in New York, I got the opportunity to interview at Fidelity. Managed to sort of land a job in the research department, and 18 years later, I'm still working at the firm and enjoying what I do.
Excellent overview. Now I knew that story about you of when you were younger, but I didn't know you started, that young, 12 years old. So it's super neat, fantastic. Don, I know that part of your investing strategy is to actively seek exposure in non-traditional dividend-paying companies. Can you just elaborate a bit on that?
Yeah, well, I think we've talked about sort of the buckets I look at in general in the fund. And, one is the secular growers. The base of the fund is always just sort of good, solid dividend paying companies. They're going to be around forever. You can count on the yield, and, over time, you're going to grow and pay, pay people a great yield. The other part of the sort of investment bucket is just looking at, and it's sometimes I have a very small weighting in it, and sometimes it gets bigger. And after going through a downturn, that bucket is specifically sort of the beaten up sort of cyclicals bucket. So you might look at sort of whether it's beaten up real estate. You might look at some metals and mining companies. You might look at some energy companies. You might look at some beaten up cyclicals that people haven't looked at. So there is a portion of the fund that depends on where we are in cycles. But right now, that portion actually looks fairly interesting because they're stocks that are still down a fair bit and have recovery potential as we head into 2022.
Okay. Don, let's just talk about this year in general, because obviously it's been an
Sure.
unprecedented year in the markets. Dividend investors have
Yep.
gone through their fair share of changes, of course. Now, historically, dividends have proven to weather this storm and produce good returns.
Mhm.
Can you talk a little bit about the distinct characteristics of dividend-paying companies and why, in your opinion, they may be a good fit in today's markets? I know you have a few slides to share on this too, because I just wanted to hit that point home with the investors on
Sure.
the line today.
Okay. We can throw up the slides in a minute, and certainly,
Hmm.
one of them is just sort of the yield slide. And so we've gone through the just general in the background for dividend companies. They tend to be companies that have been around a little bit longer. Generate decent amounts of cash flow. Balance sheets are generally relatively stable. And so they can actually afford to pay dividends, and that's nice. Cash flow generation is sort of a key part of investing in any company. And the difficult thing with some of the dividend stocks is we sort of started the year, and a lot of them tend to, because they're maybe a little bit sort of older economy, been around for a while, tend to not do fairly well in a pandemic COVID environment. And I think that's going to be the great opportunity going forward. And so I think what's really interesting about dividend paying stocks, and sort of what I'd say is a great pitch for them right now, is number one, yield. The yields across the world have absolutely been compressed, and this is the sort of the chart here. The yield environment has really changed, but one place it hasn't changed, because you did have that sort of a tough period for dividend stocks earlier in the year, is just is the yield you get from the dividends. And I get asked by a lot of sort of investors and advisors, where are you going to find yield in this environment? It's really hard. The central banks have taken yield to basically zero. If you look at, you don't get any money, keeping it in the bank. You can't find the U.S. 10-year bonds are below 1. Canadian corporates, U.S. corporates are well below average. And so the chart we put together here, and one of our fund analysts, Stu Wing, put this together for me, was basically, I wanted to look at history of yields in the last 10 years, and then where are they now? And the dots at the top are basically what the historical sort of 10-year average is, and the dots, and then the bar charts are where you would find your yields now. So if you look at sort of my dividend funds, and so Dividend Fund and Dividend Plus are sort of the two main funds that I run, you find that the yield on the portfolios are actually above average for the last 10 years, where you look at just about every asset class, and the yields are so far below average that I think it makes it really compelling. The other thing for dividend equities, I think, is just the recovery potential. So you get great yield, which you're really having trouble finding anywhere else in the market, and then you're able to look at, if you're able to look out, and the next couple of months, as I think I've mentioned before, there's going to be a real push and pull between COVID and vaccine and stimulus and no stimulus. But if we assume that hopefully vaccines, eventually are effective here, and things eventually work their way back to normal in 21 and 22, I think there's real upside to a lot of the dividend paying stocks that maybe hadn't performed quite as well over the last little bit. So you get yield and the potential of, a good upside over the last couple of years. And I think that's a pretty compelling opportunity.
So I just wanted to, get more insight on what has contributed to that and how you are actively positioning to capture as much upside and as little downside in the next year in 2021.
Yeah, so I guess how I frame this is, at the start of the year, I was fairly conservatively positioned. We hit March, and the market dropped 35% in 3 weeks. And at that point, it became the, if not now, like, when are you going to invest? There is no better time. Like, Canadian banks hit the, I've talked about it before, it hit book value for the second time in 20 years. You priced in a full recession in a course of 3 weeks. So that's the busiest period I've ever had as a portfolio manager. And it was a combination of, one, just buying things, and it was across the spectrum because everything was on sale. it was the secular winners, it was the good dividend paying stocks, it was really beaten up cyclicals. And then there was some rotation in the fund, certainly out of some defensive stuff that had in the fund, and into a little more cyclical stuff I had in the fund. And I think it was a combination of being a little bit defensive, putting some money to work. And then I'd also obviously like to point out, it's not just me. Fidelity is wonderful. The process that I use has been the same. I've been at the firm about 18 years now. And we have 36 analysts in Canada and the US who are every day are putting out research, calling companies. I'm probably spending 5+ hours a day in company, on Zoom meetings with companies now, and just finding the best ideas. So a lot of it's just been decent stock picking. Our sort of analyst team is picking out some great stocks, and it's sort of been a real team effort, and it's worked out for investors fairly well. And I'm sort of optimistic about dividend paying stocks into the next year or two.
That's great to hear. And you're absolutely right about just the depth of our team here and the research analysts. It is a truly incredible team effort. Don, I want to go back to the role of advisors for a moment. I mentioned it off the top in my intro there. Obviously, advisors help investors, foster discipline in challenging and confusing times like today, and just staying focused. If you can expand on this, because as maybe a first-time investor or even a veteran investor, the headlines that you see, especially this year, can be scary and confusing. So how do investors stay the course and stay disciplined? Can you expand on your thoughts on that?
For me, it's interesting. You watch TV and you in the internet these days, and there's so many commercials about how people should be doing it on their own. That may be fine for a number of people, but for the vast majority of people, you have a real job. You spend your entire day. You're not involved in capital markets. You're not involved in finance. You spend your entire day working to provide for your family, and then you come home at night and you spend your time in your family. You don't have hours a day to be spending on your financials. And I think one of the really great things is just having people out there that can help you sort of stay the course, stay focused on maintaining your purchasing power. When life changes for you, that your investments maybe shouldn't be the same. There's a whole bunch of other stuff that goes into just a financial plan for you. It's not just you want to pick the right funds, and obviously that's important to us, but there's estate planning, there's insurance planning, there's a lot of other stuff that goes into making a financial plan, and just having a steady hand there to sort of help you through it is definitely sort of worthwhile. I mean, I went to school with a lot of people, and I'm from sort of a 4-year commerce background. And there's a ton of them have financial advisors simply because they're not in finance. They're doing marketing, they're doing accounting, they're working for tech companies, and they're devoting their time to that, not spending hours a day on their financial plan. And it just makes sense to have the steady hand there that's guiding you and can help you through the turbulent markets.
No, and you're absolutely right about that. Just having that value of advice and that steady hand, especially during this year, it's just been an incredible year. Let's go to some of the headlines, though. Vaccines, making the waves in the news right now, as many countries are receiving the vaccines right now. So, as they're being rolled out, there are many beneficiaries in the economy and in the market. So how could dividend paying companies benefit from this?
Okay, so I mentioned sort of earlier that, and one of the reasons that sort of was fairly conservatively positioned, at least sort of into a pandemic, because you go around, and certainly for our research department, there's not a lot of dividend stocks that were, that I classify as huge sort of COVID winners. Now, to the flip side of that is there's a lot of stocks that actually will do well coming out with a vaccine. So you think about it, financials, people end up sort of going back to work. More people are employed. There's less provisions for credit losses. telecom, you get your roaming fees back, you get your fees associated with all the sports are shut down right now, but that sort of that all comes back. Just in general, you look at whether rates start rising a little bit. That's good for insurance. People decide, hey, listen, I've been stuck in the house for a year and a half, and maybe when this ends, I'd actually like to go back and go and shop somewhere. It's crazy. Everyone shops online now, but maybe I'd like to actually go and shop. That you might good, and they're head back to the office. There's some good things for real estate. So there's a lot of sectors that are sort of very dividend specific that have been beaten up. I think energy, it's not really a big dividend sector, but it's a place where I have some exposure because if you go over and look at China, they're almost 100% back to consumption of oil at this point. Eventually, North America will probably get there too. And yes, there is the secular of EVs and renewables, and I have some of that in the portfolio. But some of these things have been left for dead, and I think there is sort of interesting recovery stories over the next couple of years.
Any other sectors, you mentioned energy there, that could be COVID winners, in your opinion, in the upcoming year in 2021?
Well, I think it's sort of across the board for dividend sectors. I mentioned financials. I mentioned telecom. Like obviously there's a little bit of there's a lot of money being printed, and there's sort of a lot of money chasing fewer goods. So metals could be okay. Real estate, it's sort of really a sort of across the board on the dividend space where things actually should hopefully should get better.
Let's talk about inflation for a moment. In the situation that it could go up, with so much monetary and fiscal support in the economy right now, are dividends a good way to hedge for this?
Okay, I think it's a really good place, and we talked about it sort of earlier in the the broadcast here, but just there's very few places that you can actually sort of go and find like a 4% yield where things are getting better at this point. So the way I think about sort of inflation, I think we've got one chart here that just looks at it sort of a commodities index. I'm not necessarily thinking that the CPI, which is a consumer price index, is going to go absolutely crazy. There's portions of that, like I think they take it, if you go out and buy a computer, they sort of take it, well, the price may go up, but you're getting more power, so actually you got that as it's cheaper. But that's not the case. And the example I like to use is the grocery store. You go to a grocery store, you have $100, and the $100 basically will buy, this year will buy you a certain amount of groceries. So if I put that $100 into the bank and then I go back to the grocery store next year, what am I going to get for that? And my answer is probably less. We got the chart of the sort of the commodities index. And so what you're going to find is because there's so much money chasing sort of the same amount of goods, you'll find like the commodities index chart that I have that hopefully we can put up here is at about a 6-year high. So the price of corn, the price of oil, the price of packaging that you're going to be using at the grocery store, the price of labor is all going to be going up. So it comes into the idea of preserving your purchasing power. Next year, when you go to that grocery store, if you put the money in the bank, you're probably going to be able to buy less groceries. You might be able to buy less of a car. You might be able to buy less of a home. So one of the things that advisors can really help you do, and one of the main functions for your financial goals should be maintenance of that purchasing power. And if you can maintain, if you next year, instead of having $1, you have $1.04, you have $1.05, you can go back and you can offset that inflation that, it's not big right now, but you can see it in the commodities chart I've had here, like the money chasing goods is pushing prices up. And you want to be able to sort of protect that power, the value of your money, so you can go to that grocery store next year or go and buy, the house you're looking to buy, because lumber's going crazy, the cars you're looking to buy, aluminum's going up, steel's going up, and be able to sort of take that money and still buy the same amount of goods. And I think with yields compressed all over the place. Having a 4% yield on dividends means instead of $1, next year you have $1.04, and then you have some upside, hopefully, that can come through research and stock picking that we do here at Fidelity.
No, it all makes sense, and a great example there with the grocery store. And I know you've said many times before that dividend investing just makes sense. And I don't know if we went to that one chart about returns over time, but just really solid numbers there. Yeah.
Yeah, let's see if we can pull that chart up again. It's the percentage of your returns that come from dividends. And what you'll see over it's the other with the bar chart with the dividends in the index. And what you can basically see on that chart, which hopefully we can, here we go, is just, and what I wanted to show here is just everyone, when you think about sort of returns on an index or just returns that you're generating, I think everyone just looks at the return, the sort of return of the market going up, market going down. But I think what's lost over time is just that you're actually getting a lot of your total return from from companies paying out dividends to you. And that's the most stable part of your return and the part you really want to kind of be able to count on. Markets are going to go up and down. Over time, they'll go up because companies become more profitable. But that dividend portion is the stable portion you can count on. And this kind of almost understates its importance a little bit because, and it's looking at your total returns by decade. And what you can see, the bottom portion is your dividends. The top portion is sort of your total return. And you can say this is for the SPTSX, and it's similar for the S&P 500. But in a lot of years, it's 30–40% of your total return can come from dividends. Now, if you think about it in terms of that's just the index, and there are a lot of companies in the index that don't pay a dividend. If you're in a good dividend-paying fund, you can actually get a higher return, that nice stable return from dividends, and also get the upside from the market. And so I think sort of the idea of, take a 4% yield, 10 years later, if the market has done absolutely nothing, you've got 40% more money. And on top of that, hopefully you can get some good upside over the time. And it's sort of a conservative way to sort of compound your money, preserve your purchasing power, and hopefully do fairly well on the upside.
Well, great strategy and excellent points there. Now, just a few more questions before we go, Don.
Sure.
Let's look into 2021 and just describe your playbook and your strategy for the upcoming year. What are you keeping your eyes on? Are you looking 2–3 months down the road, or are you looking even longer term?
Yeah, the market is kind of a discounting mechanism. So the market's going to look further than 3 months. And as I mentioned, in the very near term, you got a push-pull between sort of COVID and vaccines and stimulus and non-stimulus in the U.S. But the way I want to look out to things is, what are companies going to be earning in the end of 21 and in 2022, and form a lot of my stock picks and what goes on the fund on that. And so I mentioned sort of the 3 buckets I'm in, sort of the good paying dividends, the secular winners, and sort of a little more of the beaten up stuff. And what I'm sort of interested in at this point is hunting around in sort of the beaten up a bucket, and see how much, talk to our analysts, what's the recovery earnings power on something if we do actually get closer to normal in 21 and 22. And if that's the case, can we find a bunch of things that are, really underpricing sort of return to normal and things getting better, and look at stocks that are still down somewhere between 20, 30, 40%, that over the next couple of years, I think there's really good upside. And then if things still aren't that great, they probably don't go down that much. So you've got to go to, what I like to sort of frame as risk reward potential. So your risk is much better. Your risk is much lower than your reward. If things go right, you make a lot of money. And if things go wrong, you don't lose very much. And so that's sort of the bucket I'm looking in sort of more, sort of being able to recover, and then still having the nice stable part of the portfolio that pays good dividends, good companies. You don't really have to worry about them, and some secular growth on the other side. And hopefully that sort of combination can produce good returns for fund holders.
Excellent way to frame it out for us. And obviously, still lots of unanswered questions for the next year, but just great way to sort of round it out for our investors on looking at dividend paying companies. Don, before we go, you've been with the firm for 18 years. You've been in the industry for over 20 years.
Yeah.
I'm just curious to know, if you weren't, doing what you're doing now, if you weren't a portfolio manager, what career do you think you would be in?
It's sort of an interesting one. If you go by family history, I should be a teacher because my entire family has been teachers throughout time. I would tell you, I probably wouldn't have gone that route. I really do love what I'm doing. It would be something related to this, so I'd probably be at a big corporation doing corporate finance or corporate development or something like that, trying to build a company. It would be something related, but not the same thing.
And I absolutely believe you because of your story you told off at the top of the show there, paying into your first stock at 12 years old. Don, I want to thank you so much for being on the show today. Just, sharing your insights about the year that was 2020 and just what to expect in 2021. Thank you so much for being on the show and speaking to our investors today.
Great. Thanks for having me, Emily.
And happy holidays to you too.
You as well.
And thank you for watching and participating with us on the Upside. That wraps it up for us for 2020, but we will be bringing you more Upside shows in 2021, of course. Just visit fidelity.ca for more information. We also have the Upside on YouTube, covering a range of topics from ETFs to investing best practices. And for more Fidelity portfolio manager commentary, you can find us on your podcasting platform of choice by just searching Fidelity Canada. Wishing you all a safe and healthy holiday season, and we'll see you next year on the Upside.